Good morning, good afternoon, or good evening, whenever you may be listening. Welcome to episode number 29 of The Rent Roll, your podcast on all things rental housing, apartments, SFR, BTR. Today, I have the privilege of being joined by one of my favorite people in multifamily, Antonio Marquez, the founder and managing director of Comunidad Partners based in Texas. We're going to be talking about cutting through the buzzwords and sometimes loaded language associated with workforce housing, with a reminder that no matter your preferred word choices, if you do it right, you can move the needle for your investors and for your residents. And Antonio, if you don't know Antonio, he has a powerful story to share from his family background. So we'll get into that, and we'll talk about how to properly think about the linkage between investment impact and social impact in tangible ways, not just the buzzy word choices. But before all that, we're going to nerd out a little bit on some lists. The NMHC Top 50 is out. For those unfamiliar, every year, the National Multifamily Housing Council puts out rankings of the largest apartment owners, managers, developers, builders, and syndicators, and the tax credit syndicators, I should say. And we'll dive deep into trends and histories and implications around the NMHC Top 50 owners and developers in particular, and a bit on managers too. Some really interesting stuff there beyond just the names. So we'll dive into a little bit of history and trends, and also how to talk about it in the public realm, where these things can be really just combating this myth that the sector of multifamily and SFR is being dominated by a handful of large players. The data is going to show us just the opposite. In fact, it's even a more fragmented story than it has been in the past. Before we dive in, I want to give a big shout out to our sponsors. First, to Madera Residential, an owner-operator in Texas, and JPI, a leading apartment developer. So, as always, we're going to jump it off with here's a chart. Kick it off, I should say, not jump. We're going to kick it off. All right. So, first thing we're talking about, going back to the NMHC Top 50 owners. And I got a chart for those of you who can see the screen. It's going to show you the history and distribution of the NMHC Top 50 owners. Before I dive into that, though, I want to share just the quick highlights. All right. Greystar remained at the number one spot, padded its lead, added another 13,200 units last year, now at 122,500. Also in the top five for net gainers, so not top five overall, but net gainers, Related added more than 11,000. FPA added more than 10,000, Fairfield plus 7, UBS plus 6.5, and Widener up 4.5. And some new entrants to the top 50 owner list includes S2, Richmond Group, MLG, Amley, and Kairos. So some good names there, but all that's great. But let's open up the history books a little bit. Let's talk about the history of this list going back to 1990. So coming back to this chart, if you can see it, this chart is a box and whisker chart. I know, a little bit nerdy, well, a lot nerdy, showing the size of the top 50 owners from 1990 to 2025. And here's a fascinating stat from these lists. So I alluded to this earlier. You might assume that it takes more and more units to make that top 50 owner list, and it's a reasonable assumption, but it's also an inaccurate one, I should say. The floor for the top 50 really hasn't changed much at all in the 2.5 decades since this list started. It's taken 20 to 25,000 units to make the NMHC Top 50 for pretty much every year since inception in 1990. The biggest difference is the tighter band today between number 1 and number 50. It's a highly fragmented market. Well, Greystar's number 1 today on this list, it's at 122,000 units. By comparison, the top players from 1999 to 2016 routinely had 150,000 plus units. And in the early 2000s, we had some players over 250,000 units, topped off by Charter Mac with 324,000 units in 2005. Some of you may remember that name, and it's changed names a few times in history. We'll talk about that in a little bit. Of course, we do have a few owners that don't participate on the NMHC Top 50 lists, and that may tweak these lists a little bit in this chart a little bit. But even so, we just don't have as many mega players that have as we did a couple of decades ago. And that's also reflected when we look at the share of apartments owned by the NMHC Top 50 owners over time. This chart showing you it's an incredibly diverse and fragmented industry. People just don't appreciate this point enough, especially politics and media, people in politics and media. But even in our own industry, the NMHC Top 50 owners had a combined 14% market share back in 2000. By 2010, it was 15%. In 2025, it's about 11%. So it's gone down, not up. And, the truth is, I've shared this chart previously. It shows you the market share of the top 50 U.S. apartment owners and SFR owners versus all others. And it reflects that even the biggest players in multifamily and SFR just are not that big. The biggest apartment owners have less than half of 1% market share. The biggest SFR owners have less than 1% market share. On the SFR side, it's Progress Residential with a whopping 0.57% of the SFR market. So most of the market, again, is owned by those well outside the top 50 in size. Now let's compare that to other industries. The U.S. market share of the largest provider by industry. And you can see apartments and SFR are both around 0.5% or so. You compare that to other industries. Look at online search. Google has 90% of the market. Look at AI chips. NVIDIA is at 80% of the market. Credit cards, Visa, 61%. PC operating systems, Microsoft, 60%. Smartphones, Apple, 53%. Online retail, Amazon has 40% of the U.S. market. Healthcare, HCA Healthcare has 27%. Pharmacy, CVS has 26%. Grocery stores, Walmart has 24%. Automakers, GM, 17%. Banks, JP Morgan Chase, 12%. Property and casualty insurance, State Farm, 10%. So these are just some numbers able to gather from publicly available information. All of these are big companies, right? They are some of these are some of the biggest companies in the world. And so sometimes when I see, the larger apartment and SFR owners positioned as these behemoths, it's terribly misleading. They're large by comparison to their own industry. They're tiny in the big picture relative to market share leaders in pretty much any other major industry. So we need to be much more honest about the fragmentation of this market, and really just the great story about rental housing, both SFR and multifamily, is just how accessible it is to new entrants relative to other industries. All right, let's dive a bit more into the NMHC Top 50 Owners List going back to 1990. Here is a fascinating stat. Another one. I've shared a few of these. We've had 14 different NMHC number ones in the 26 years of the NMHC Top 50 Owners List. So we're going to go through some of the history here. And I do hope there are some history nerds listening, because I think this is pretty interesting, and I hope I'm not the only one. So we're going to run through these 14 number ones real quick and see where they are now. Okay, so let's start off with back in 1990, the first NMHC top owner was a company called NHP. It was acquired by Aimco in 1997. NHP topped off around 100,000 units or so. And then we get to another next one outside of NHP was a company called CRI. Couldn't find a whole lot about where CRI ended up. If somebody does know, send that information to me. It looks like it just divested over time through numerous property sales. Could have been some other issues going on there, but I couldn't get some really good information. And there's also other companies called CRI that still out there in existence today. And then next one we'll talk about is Insignia Financial Group. Okay, Insignia led this list in 1996 and 1997, topped off 135,000 units. And it, too, just like NHP, was acquired by Aimco in 1998. All right, next one, the name that'll be more familiar to many of you, Equity Residential, obviously still an active player. It first made the number one spot in 1998. At the time, it had 138,923 units, which is more than it has today. That's back when Equity Residential was in a ton of markets all across the country. And then obviously Sam Zell changed the strategy and focused on a smaller number of markets. And now they're entering some of the markets they exited out of again, but only these bigger Sunbelt markets, not some of the smaller ones they were in back in the day. Next one we'll talk about is Aimco. It's obviously still around technically, but it's a shell of its old self. It shrunk down in size considerably over the years before it started spinning off most of its portfolio as Air Communities back in 2020. And then Air was sold to Blackstone for $10 billion last year. Aimco topped off at 265,620 units in 2001. So that's quite massive, 265,000 plus units. Another one, Related Capital. Related Capital made this list in 2003 with 275,000 units. Related Capital was acquired by Charter Mac in 2003. And that leads us to Charter Mac. Charter Mac ended up taking the list in 2004 and 2005. Many of the same properties, topped off with 324,711 units. It was renamed to Centerline, later acquired by Hunt Companies in about 2013, I believe. We'll come back to Hunt in a moment. But next up, MMA Financial. Some of you remember that name, a little blast from the past there. 2009, MMA had 186,000 plus units as the number one apartment owner. It was a subsidiary of MuniMay, operating affordable housing, acquired by Gen Partners, I believe, in 2009, renamed to Boston Financial, and then sold to Oryx in 2016. By the way, this is just some of my online research, but if I get any of this wrong, please do let me know, and I'm happy to get this information corrected. I just thought it was pretty interesting to share. And that takes us to Boston Capital, which held the top spot in the NMHC top 50 ownership rankings from 2010 to 2013, topped off 162,000 plus units. Boston Capital is a pretty interesting story, and obviously still around. At one point, Boston Capital had 3,700 multifamily properties located in all 50 states, according to their website. A big player in affordable housing. But then that portfolio was sold in 2020 to Boston Financial, the former MMA Financial, and Boston Capital shifted the debt financing third-party asset management. So it was a Boston to Boston deal. It gets a little confusing there, and hope I didn't mess up any of those details. And the reason that Boston Financial, by the way, is not on this list now is that NMHC is calling them a tax credit syndicator, puts them on a different list, and they ranked number 2 on the NMHC top 10 syndicator list with more than 154,000 units. All right, I mentioned Hunt Companies earlier. Let's touch on Hunt. Hunt topped the list in 2014, 2015 with topped off at 253,000 units, operating out of El Paso, Texas, acquired the Centerline, which I mentioned earlier, as well as Ledick in 2014. Now it's number 17 on NMHC's top 50 ownership list. And then Alden Torch, another tax credit syndicator, among other things. And going back to Hunt, that business line was actually acquired from Hunt Companies, I believe, in 2015, sold back to Hunt 2 years later, where it's now called Hunt Capital Partners. And it, too, has been in the top 10 NMHC syndicator list, as well as Hunt spot on the ownership list. And that takes us to the last 3 names, which have been a little more familiar. MAA has topped this list off several times. Had a streak from 2017 to 2023 where it held that spot for all but 1 year, topped off just over 100,000 units, and obviously still an active player and the number 2 on the NMHC 2025 ownership list. Starwood had the top spot in 2022 with 115,000 units, and these last 2 years, Greystar's topped the list, now at 122,545 units as it shifted, or expanded, I should say, from its historical management business, and now moving also in the ownership side. Now, before I move on, I want to take a quick look at the NMHC Top 25 Developers list as well. Okay, so Greystar remained the top developer by unit count, 8,247 units started in 2024. That's down 1,315 units from 2023. So even the biggest guys are having a hard time starting as many projects as they did in the past. 4 developers went against the grain, though, by ramping up starts on more than 1,000 units compared to 2023 levels. That's Dominium, up 2,700 units. Continental up 2,300. Crescent added another 1,500 from top of the prior year, and D.R. Horton up 1,200. Each of those, starting anywhere from 2,400 to 5,800 units last year. Also, big shout out to JPI, jumping from number 23 to number 18 in the rankings with about 2,100 units started last year. And then some new entrants to the top 25 developers list, which include a lot of returning members who dropped off last year, the prior year. Continental, Crescent, Annex, Avalon Bay, Landmark, Cortera, which is part of Lennar, TWG, and Dinnerstein. Now let's look real quickly at the history of the NMHC Top 25 Developers list. One major similarity to the ownership list and one major difference. The big difference first. Well, we've seen the number one owner in the NMHC ranking shift a lot over the years. It hasn't been true for the developers. In fact, it's traded hands every year since 2015 between just two players, Alliance and Greystar. And this chart shows the leader has traditionally started around 8,000 to 9,000 units each year, except in 22 and 23, obviously in the boom times when the leader got up to 14,000, and we had a bunch that were over, well, I say a bunch. We had, five, I think, above 8,000 units and four above 10,000 units in 2023. And let's see, where was I going with that? So this year, back around 8,000 units led by Greystar. I alluded to that earlier. But here's what's also interesting, though. The floor of the NMHC Top 25 Developer list is actually the lowest since 2025, meaning the number 25 in the rankings has started the fewest number of projects for any number 25 in more than 10 years. That just reflects the difficulty for even the biggest players of getting new projects going in this environment of high rates, lots of lease ups in the market, flat falling rents, et cetera. And also just challenging getting equity, obviously. But here's the similarity with the NMHC top owners list. So I mentioned, you have two players trading hands number one spot, but even with that, it's a very fragmented market. The top developers represent a relatively small share of apartments started each year. Traditionally, the top 25 developers combined start only about 20 to 25% of all new multifamily units nationally, reflecting that this is again, much more fragmented market than the single-family home builder market, which is dominated by a handful of national players. Most apartment development is still dominated by local players. But given the headwinds facing developers today and the challenge capitalizing deals and the challenges of finding the scale to reduce construction costs, this could be an environment that might favor larger players. In fact, when you look at the RealPage data on starts last year, this story has begun to play out. The NMHC top 25 developers represented about 32% of all U.S. apartment starts, and that was up from just under 25% in 2023. And so that's a pretty significant move of the needle. It's the biggest jump we've seen in the 10 years of history that we have from the NMHC top 25 list. All right, so I don't have time to get into all of the other lists for managers, builders, and syndicators, but certainly hats off to everyone who made those lists as well. Next up, rental housing trivia. All right. So today's trivia question sticks with the theme of the NMHC rankings. And the question is, what company has held the number one ranking on the NMHC Top 50 Owners list more times than any other company since 1990? And your hint, this company has appeared number one 7 times. All right, so we'll answer that question in a bit. But next, in the news. All right, we got a few headlines. We got 4 headlines to review this week. First one comes to the Wall Street Journal. Apartment shortage draws a major U.S. landlord to the Midwest. Morgan Properties pays $501 million for more than 3,000 units, lured by the lack of supply and signs of job growth in the region. All right, so not a big surprise here. More interest in the Midwest. Yet another sign that the Midwest is having its moment with Morgan Properties buying this 3,000 plus unit portfolio from Trilogy for a little over $500 million. That puts Morgan over the 100,000 unit mark for units owned. And here's a good detail from the Wall Street Journal article that Morgan gave them. Morgan owned, or the detail that Morgan provided to them. Morgan owned 793 units in the Midwest prior to COVID. And with this latest deal, their Midwest tally is now 14,500 units. And so I don't even know what that is, but that's up a lot, right? 793 to 14,500. And I've talked about the Midwest a lot in this podcast. I'm not going to repeat myself here. Obviously, the Midwest story is about steadiness, predictability, lower ceiling, but a higher floor than the Sun Belt and the coast. Good character, history, steadiness, predictability. You don't have the political volatility and rent volatility you see in the political and rent volatility we see in the coastal markets, and then also don't have the supply headwinds we see in the Sun Belt, but still have the affordability advantages that we see in the Sun Belt. So a little bit of the good from the Sun Belt and the coast without the major headwinds from both of those spots. Next headline comes from Novogradac, and it says HUD releases 2025 income limits. And the few takeaways here from Novogradac, which always does a great job analyzing this data. The average increase across almost 2,500 areas that HUD publishes income limits for was 6.2%. 27% of the areas were capped at 9.2%. 41% had an increase of more than 8%. 71% topped 5%, and 5% actually had a decrease. So it was higher than expected this year. And Novogradac said that the reason was because of a methodology change from HUD and how they calculate income limits. And basically, it said HUD starts with the most recent ACS data from the census and then uses a trend factor to trend the ACS data to the income limit year. But for the 2025 income limits, the most recent ACS data was from the 2023 ACS data. Therefore, HUD had to trend the ACS data from 23 to 25. All right. So it gets a little wonky there, but that helps explain a little bit of what happened. There's a lot more details on Novogradac's website if you are curious. So implications from this, number one, we raise the income limits, more people are eligible for HUD assistance and LITech properties. And number two, maybe we hopefully see higher income limits could help more affordable projects pencil out. Next headline comes from Biz Now. Headline is Tweaked DC Eviction Bill Advances as Council Members Weigh More Changes. Efforts to reform DC's eviction laws in response to a surge in unpaid rent are one step closer to becoming reality. And as you read into the article, I would say that these changes are not all that dramatic. I talked to an affordable housing investor recently whose company redlined Washington, D.C. entirely due to city policies that have effectively made rent payment optional. Quote from the article, it says, the district's average of $2,207 of unpaid rent per unit is by far the highest in the nation. So obviously, eviction mitigation programs can play a critical role, but they need to be appropriately funded. And additionally, the city needs to make a real effort to root out fraud. And then you can be more effective in helping out the households who are really struggling to pay rent each month. One more headline. This comes from the New York Times. The headline is Watchdog Agency to investigate attempted cuts to fair housing groups. The inquiry is another roadblock to efforts by HUD and DOJ to slash funds earmarked for the enforcement of the Fair Housing Act. All right. So a lot of loaded words here, right? This one kind of got me perked up a little bit. So obviously, let's state the obvious. Fair housing laws are critically important. Okay. So, but if you think about this, what's happening today is HUD doles out millions of dollars to countless local groups that have minimal oversight and accountability. And so I just want to think about this for a minute. Like, surely there must be a better way to enforce a critical set of laws like fair housing than to just distribute millions of dollars to countless local groups. You know, I just got to thinking, like, what other federal laws require such a fragmented model? Like, is this really the only way? Like, I think the lack. I mean, I don't want to pretend to know all the facts on this issue, so I'll put that disclaimer out there. But the framing of this article reflects a lot of the tone I see these days about HUD in particular. I think reflects a rather peculiar way of thinking that assumes the status quo is actually working and is effective. And I think what we really need to see is a little more intellectual curiosity and thinking about, hey, are there better ways to enforce fair housing and to protect renters? And, I don't know this firsthand, but I assume that's what Secretary Turner of HUD has really been talking about when he says, hey, we're going to focus on what works and we're going to take inventory and those kind of things. And so the lack of real intellectual curiosity to explore that, I think is just rather odd. Because again, surely there's a better way to enforce the law than to just give out millions of dollars to countless local groups and no oversight and tell them to have at it. Like that just doesn't make sense. Surely we can do better than that. So we'll see. All right, back to today's rental housing trivia question. What company has held the number one ranking on the NMHC Top 50 Owners list more times than any other company since 1990? The hint was happened 7 times, and the answer is Aimco. So Aimco held the top spot 4 straight years from 1999 to 2002, and again from 2006 to 2008, topping out at 265,620 units in 2001. That's more than Greystar's own portfolio today by more than 2 times, just for some context there. All right, and that'll take us into today's interview, where I'll be joined in studio by my friend Antonio Marquez, who is holds leadership roles of the National Multifamily Housing Council and the Multifamily Impact Council, and also is the founder and managing director of Comunidad Partners. So please welcome in Antonio. All right, now we enter the interview portion of today's podcast, and I am absolutely honored to welcome in my friend, Antonio Marquez. So, Antonio, thanks so much for being here.
Jay, thanks for having me. It's an absolute pleasure to be here. Awesome space. We're at the Star in Frisco, everyone. So Many of you probably don't know that we're actually really in the heart of Dallas. And
you're kind of to make the trip north from Dallas, where you're at for Priya. So good event down there, and hopefully people are starting getting ready to actually spend some money and get deal flow moving again.
That was part of it. Yeah, it is an interesting time, in that respect, and we'll get into it a little bit more. But it's awesome to be with you.
So Antonio, before we get into your company, Comunidad Partners, can you talk about? One thing I think is interesting about your career and your trajectory is you developed a passion for housing, specifically workforce housing, earlier in your career before it was really cool, before it was really a thing. So where did that passion come from?
Yeah, well, I appreciate the question. I am very passionate, and it comes from a deep-seated, kind of ingrained part of who I am. And a lot of people ask me what we do and how we do it, and I appreciate, Jay, how you phrased and how you started the conversation, because it really you can't answer those questions without answering my why. Mm-hmm. And my why starts not with my origin story, but actually the origin of my origin story, and it really starts with my family. Mm-hmm. And I'm a first generation Mexican American. My father immigrated from Mexico, came to the United States. He was a farm worker in California, so pre-Chavez, so no civil liberties and no workers' rights, and started a company out of his garage and turned that into the largest distributorship of Hispanic grocery products.
Wow!
So he was selling wholesale, and as a young man, growing up with my father, growing the business, I had to grow up really quickly. I had to be an entrepreneur quickly. I had to understand how to adapt, how to build a business. The immigrant grit was real, the work ethic. I remember we'd jump in a van, we'd go down to Mexico, we'd go and, buy all these jalapenos and jarritos and all the things that you know of. And so, it was imprinted into me in a very young age in terms of how to really build a business, how to be thoughtful, how to solve problems, how to tailor a product towards your customer. Mm-hmm. And so that was some of the best, that's the best school of hard knocks that you could ever get. And my dad did not want me to go to college. He wanted me to just be in the family business. Luckily, my mom had more of a say than he did in the household. And so was the first to graduate college in my family. Went to the family business, which was exciting. I was in it for a long time. Yeah, helped my dad grow it. He ultimately started buying industrial real estate, very back of the envelope.
Wow.
This is a man that didn't speak the language, didn't have more than a fifth grade education. Even in, living in rental housing, his first job application was filled out by the property operator, the landlord, ultimately. So, wow. So I really, started Comunidad with this vision of how could you differentiate housing? Because I had an affinity towards real estate. And through all these learned experiences through life, again, my father and my family having, certain challenges in terms of making in the country, and they created their own dream. And I'm so grateful for that, sitting here today. And Comunidad was my version of how to pay it forward, but doing it in a sustainable way that is business oriented, because we're very much capitalists at heart, but I really do believe in conscious capitalism and really adding value in differentiated ways. So even in terms of the programming and that sort of thing, which we'll get into, and the value add and the community build, it's really informed through that. And that's what really drives my passion.
Well, and you've been able to use that passion not only in your own platform, but also now across the industry, the Multifamily Impact Council, you've leadership role, NMHC leadership role. So, you've really had a broad impact across our country. So now I love the family origin story. So now let's fast forward. It's 2007. Mm-hmm. I mean, what a heck of a year to be an entrepreneur getting into the housing business. I can only imagine what that was like in the first couple of years. But what inspired you to start the company, and just what were those early years like?
Rough is the most, probably the simplest way of saying it. And, even my father said, to me in Spanish in a different way, but, paraphrasing, I was an overnight success, but it was 30 years in the making. And so that's how I feel in terms of, in terms of the underlying, but also that's what's made me appreciate it so much. It's made us drive for more, to try and, create and innovate and, have kind of fidelity towards, our mission and what we believe in. In 2007, that was a time, and actually it started before 2007 because it was really 2004 where I was formulating how I wanted to do it, what I wanted to do. And by the way, I had no real estate relationships, no network in commercial real estate. I didn't know how to use Excel that well. I mean, that's some in college.
They don't teach it in college.
Right, exactly. Not that there's something you need. And so all of it was, learned through relationships, triangulating, having humility, but also having boldness in terms of being inserted in those groups and having those conversations, asking questions. I always say, there's so much underlying in stupid questions. Ask the stupid questions because you can find some pretty bright answers when you actually ask them, especially with, given it's the first principles. But, it took me about 3 years. 2007 happened, Bear Stearns, Morgan Stanley. Yep. I started the business a month after Lehman Brothers collapsed. So brilliant timing, and in retrospect, it was brilliant timing. But what's fascinating about history is most people look at opportunity only when they look back. Yeah. In the existing environment, it's risk, right? Yeah. But, people thought I was crazy. But I started in 2007. From my perspective, I'm always a glass half full type of guy. It was the best time, although there was a lot of volatility in the market.
There's probably little parallels to today, too. It's like, all these headwinds he'll talk about, supply and interest rates, everything else. And, you can see that as a challenge. You can see it as opportunity.
That's it. I mean, and some of it's intuitive. I mean, again, being at PRIA, there is... some folks are optimistic, but there is fear that sets in. Yeah. And
that audience is risk first sort of mindset.
Yes, exactly.
I don't want to be insulting, but
No, and in certain respects, you're a fiduciary and you're downside protecting and that sort of thing. But that's why we exist. Yes. As GPs, as the entrepreneurs in the room that have the finger on the pulse, that are, have the skin in the game and understand and are willing to put our reputations on the line when we actually say, and by the way, we haven't been acquiring much in the last 3 years. Yeah. I'm starting to think, we're now starting to we made a couple of acquisitions last year, but we think it's, back risk on pretty soon. But it is, it's just human behavior. It's behavioral economics. Yeah. And so, in 2007, I look at a lot of parallels to today, and it's the reason that we're so excited about what's happening. Yeah. Heading forward.
So tell us more about the portfolio. How big, where are y'all located, type of assets, all those kind of good details.
Yeah. So our portfolio is about $1 billion right now. And we have about 6,500 units. We've contracted. We were at about 15,000 units at our height. We systematically divested. We've been doing that over the last 5 years. And really, part of that divestiture was, markets were hot, but even, from 2022 on, we've actually identified some interesting, trades in the market. Yes, yes, values are lower, but our view has been, let's generate liquidity now. Yeah. We're still making great returns on those investments. And we're really focused on vintage risk and some of the other inflationary pressures that are occurring, that are, I think, are something from a risk management perspective is important to be judicious. And then in terms of regions, we're Sunbelt focused. Mm-hmm. Despite all the headline risk in terms of Sunbelt, we feel very bullish about the secular tailwinds. And the other thing that I'd say is workforce housing, again, not immune, but it's been relatively resilient. And I know that's pocketed in certain markets.
So there's been good research on that too.
Yeah, exactly. And I think it's really about picking your spots.
Yes.
And this is the other reason that being a sharpshooter, vertically integrated, that has a really good finger on the pulse and not only understands the markets, but the submarkets and even the micro pockets within the submarkets, creates value, and you can kind of pick your spots and unlock value where other folks might be having a broad stroke approach.
Right.
So yeah, that's kind of the portfolio. And again, all workforce housing.
Yep.
That's all we've done since inception, pure play, haven't had style drift. We still are firm believers in it. And as we were talking about Priya, there is a lot of excitement around workforce housing.
Yeah.
I mean, outside of data centers and, industrial is a little bit over allocated, but there's still some excitement. But outside of data centers and maybe senior housing, workforce housing is right there in the top three.
Absolutely.
And it's still misunderstood. It's still not institutionalized. And then the other thing is it's hard to find firms that have the infrastructure to scale, to execute, to do all the compliance and regulatory, aspects of it. So that's why we think it's a super exciting time.
Well, and you mentioned the vintage risk. I think one thing that's interesting about workforce housing, to your point, is the lack of institutionalization.
Yeah.
A lot of what we'd call workforce housing is older, properties that are not in good shape, have a lot of CapEx needs, versus I would say like the more modern workforce housing, better condition, more institutional grade, but still have those rents that are at workforce levels. Like that seems to be the real sweet spot.
It absolutely is, Jay. And even, we've kind of migrated towards that. I mean, we cut our teeth in 70s and 60s vintage, 80s vintage, and there was great value in that. I mean, in an environment
especially back then.
Yeah, precisely. And yields were higher, cap rates were higher, but also, expenses were more predictable.
Yeah.
And, when you look at, OpEx margins are one of the heavier risk items in this type of asset class. And so, when you have insurance that blows out, and you have payroll costs that drive higher and that sort of thing, rents have grown, right? There still has been some meaningful rent growth since we started, but even from 21, 22 to now, it's been moderate.
Yeah.
But expenses have outpaced that. And so in that sort of environment, you're trying to figure out, well, how do you mitigate risks while still meeting a need? Because the product that we're buying now is 90s, 2000s vintage. But, and you think about the development curve. When I got into this business 15 years ago, we were buying 80s and 70s vintage. That makes sense. 15 years later, 90s and 2000s, because you think of workforce housing as the feedstock of the A class. And we talk about this filtering, these filtering effects and that sort of thing. So that's why we feel like there's a great runway long term. But risk adjusted, that newer vintage makes a ton of sense, not only just for deferred risk, but insurance risks, reputational risks, a whole host of other risks that we're trying to mitigate.
Absolutely. So, Antonio, let's talk more about your model, because I think you have a very unique model with a combination of a for-profit and nonprofit pieces that come together and the linkage. But you mentioned earlier your conscience capitalism. So talk about how that works for your company, because you have a really interesting social impact through after school programs, meal programs, and whatnot. So can you talk a little about how those two come together?
Yeah. And, it starts with kind of the fundamental underpinnings of our business and really first principles in terms of how we just approach everything. And it's really about people and how do we serve people? One of our slogans is people serving people. But you have to understand the people that you're serving first. And so we've been really intentional about really, creating a community and reimagining housing in terms of what do residents need and trying to solve those problems for them. Mm-hmm. And so, and we want to also decommoditize the space. Workforce housing can be relatively commoditized, but it's very operational intensive. And so if you really understand what the customer's needs, wants, and cultural idiosyncrasies are, then you can tailor programming that fits those needs. And as a result, you just have better retention, you have better resident experiences, and that all translates into financial performance. So the way that we thought about that problem and how to solve that problem is, how can we provide impact programming? And you can call it whatever you want. I know, there's some terms out there that are getting some heat for various reasons, political or otherwise.
We're just changing the words now. So
I mean, that's really what it is. I mean, frankly, it's function over form. And that's what we say is like, whatever term is palatable, that's fine. At the end of the day, what we're doing is We're providing a better product, and we're managing risks, and we're trying to drive, alpha. And if that's not what investing is fundamentally about, I don't know,
Well, and sometimes I think too, like the words, we've all seen cases where these words are being maybe misused to extreme examples. But in your case, what you're talking about is people serving people. You're talking about just the core, just taking care of people's needs. And if you do that, if you take care of people, take care of your renters, your investors, like you should see good things come from that. I mean, it should be that simple, regardless of what we want to call it, right?
That's exactly it, Jay. I mean, that's precisely what we're doing. And it's really, drilling into those underlying factors. And it's the blocking and tackling of what business is all about. And, you have different ways of approaching it, and you can use technology, you can use different programming and that sort of thing. But that's effectively, what we're talking about, which is exciting. I mean, it's no different than, we look at our impact as a customer experience officer, right? Really having, better services and that sort of thing. So the way that we've looked at that is historically, we did all that in-house. We did that with our asset management team. We outgrew that in-house, and we realized we needed our asset managers to be asset managers.
Yeah.
And so we ultimately housed that function with a nonprofit by the name of Veritas Impact Partners, and then continued to grow that platform. Now we also partner with Rainbow Housing, so we've continued to kind of scale that out. But the whole premise is, how can we just give that playbook to a nonprofit that has its own funding stream, that has its own dedicated personnel, and provide impact programs to residents. And so where we started, was we had this kind of top down approach in terms of what we thought might be the best programs for our residents. That worked to an extent. It was well intentioned, but we realized that it really had to be bottom up. So now we have surveys, data, technology that we actually utilize to help inform how we approach it. Before, we used to say we have a menu, we have a program, and then we actually deliver that menu to the communities. That's still, that's still applicable to a certain extent. Now it's almost like if you have an Instagram or Facebook, data where you're actually building profiles on residents and you're understanding what their nuances and behavioral, attributes are, and then you're formulating the programs for them. Because sometimes residents, and this, I don't want to sound like, we have, some sort of omnipotent understanding, but sometimes residents don't even understand what they really want until you offer it.
Oh, yeah.
Right?
Well, that's true. All consumers of all,
right?
Yeah.
And so
Steve Jobs quote, I forget what it was.
That's precisely it. Yeah. And so it's really a blend of kind of the quantitative and qualitative, getting these profiles. We have 2 specific profiles within our resident demographic that we've identified through a whole litany of different profiles. We've used Esri data, census data, Yardi matrix data, and just put together 2 profiles. One of them is young families, and so normally it's a head of household is the primary breadwinner. That's a full-time job. The second is normally part-time. Still kind of dual income, but they're kind of balancing kind of job and life and the personal things like picking up the kids from school or taking the laundry, and just other errands. So that's one component where we've actually kind of defined programming around that cohort. The other is just kind of young professionals that are in certain trades. They could be, a manager at a Home Depot. They could be a driver for Amazon. They could be a gig worker, that sort of thing. So really understanding, the convenience attributes, because they might not have everything at home to provide, to make food, consistently. So we'll actually have a food program that comes in that has cooking classes or other things that we can actually do. So we thought about it in the context of how can you add value? And more specifically is making the correlation between resident NOI, as we call it. And if we actually can boost resident NOI, then the byproduct is property NOI.
Yeah.
So resident NOI, if we're able to increase their incomes by vocational skills training or job skills training or job placement. We had a really cool partnership with Amazon where they needed employees, at their facilities. So we partnered with their nonprofit to provide, jobs that were higher paying, more durable.
Wow.
That creates a really sticky tenant. And then we reduce expenses through after school programs and financial literacy and other things. So if we're able to increase resident income and reduce their expenses, we can, maximize their NOI and disposable income. So
that's amazing. I imagine that's got to be a big differentiator, because that's got to give your residents much more loyalty than you probably typically have in your average apartment community.
Yes, and it's showing up in the numbers. I mean, from a retention rate perspective, our turnover rate as well. So last year, same store was 26.5% in turnover. So we're very proud of that. For
those who don't know, that's a very low number, especially in the Sun Belt. So
yeah, precisely. And then many people say, okay, great, you got low turnover, but then that means you're probably not, probably don't have any rent left. Our renewal trade out was 8.2%. So we think that's pretty meaningful.
But again, if you're putting money back in their pocket through other things, that's probably more affordable to them than it would be otherwise.
Yeah, and we have this concept of abundance. We want our residents to see outsized value relative to what they're investing. And then it becomes less of a, it becomes more of a decision that's based on what is beneficial in terms of the totality of their life, as opposed to just renting for shelter. Right? And then that value proposition, just like Starbucks and Disney and all these other brands, when you look at workforce housing, I mean, a lot of these other brands have been really effective at creating that value, that it's real value, but it's also perceived value, and you kind of need both to build that loyalty over time.
So when we think about workforce housing, I think most of the industry thinks of specific programs, like here in Texas. Everyone's PFC, HFC, which are kind of under fire right now, maybe going to see some modification. And just as a side note, I'm a little about throwing baby out with the bathwater here. Hopefully we come up with some common sense reforms, as opposed to removing the impact those programs have had. But how do you invest at those rent levels and provide these services without, as I understand it, using programs like that?
Mm-hmm. So a couple different ways. Well, one, part of it is, so there's that piece, right? There's the structural advantages. The other piece is the operator to kind of drive value. So I was talking earlier about some impact programming, but that stems to marketing, operations. We've got our own revenue management, system that we've built over time. There's a workforce housing specific, so we know all of the scrutiny that the DOJ has provided on a lot of different operators. Fortunately, we built our program to not have that sort of data. So we were protected from that perspective, but it also has some nuances. For instance, in workforce, we hold pricing for a week or even 2 weeks, because it's normally a renter household that wants to, know where they're living. They want to see where their kids are going to go to school. And so it's not really a daily, kind of temporal decision. So those are kind of the operational attributes. In terms of structural attributes, we're leveraging things like tax abatements. HFCs and PFCs have been maligned, and they've had a lot of scrutiny and that sort of thing, and they kind of evolve. And so, part of our concern with all that is the regulatory uncertainty. It is a shame, because they're highly impactful, and on one end, jurisdictions are saying that they need it, and then on the other end, they're effectively dismantling, as opposed to retooling. And so the concept is fundamentally appropriate. The way that you go about it can always be adapted, just like anything else. And so there are some really interesting, there's interesting new legislation that's popping up throughout the country. I mean, you're seeing it in certain states throughout the country, and even local jurisdictions, local cities. I was just recently spending some time in DC, on this exact topic. It's getting a lot of attention. And so there's still a lot more to determine. I think the question is it better housed in a PFC, HFC structure? Would it go through a PHA? Would it go through a nonprofit? So there's an interesting tapestry. But one thing that I know is that this is where the industry is moving, because it is a very, very effective, tool, among other things. So we're leveraging stuff like that. There's grants that are out there that we're tapping into. Financing still exists, not only just with agencies, and they continue to do more admission-based business, but CRA and CRA lending. So it's really kind of a multi-tiered approach, Jay, in terms of finding different ways of structurally either compressing costs or having better cost of capital. Some of our strategy also leverages lower cost of capital, even on the equity side. So it's just a combination of all those different things.
Yeah. Well, and as a side too, I think it'd be nice if we had more kind of by right, workforce housing development, as opposed to these programs that have so much subjectivity at the city level, because that certainly adds for a lot of complexity.
Yeah. No, I mean, that's precisely right. I mean, there's data that was released. I know you're very familiar with 40% of all development costs are attributable to regulation, and the NIMBYism doesn't help, right? The misunderstanding of it doesn't help, and even just the code, the code, baggage that occurred over decades, right? And so some of that has really layered on top of layer on top of layer, because you have so many constituents and so many agencies in the local jurisdiction that are trying to provide their own prevention mechanisms. But again, it hasn't been a first principles. There are some cities throughout the country, like complete communities in San Diego. You have also in New Hampshire. I was also in Maine recently, where they were actually doing some really interesting stuff around how do you really reduce regulation to actually translate into more development. So I think more of that's going to occur, and also you're likely going to see DC trying to really incentivize, really kind of align some of the federal policy and what they're looking for, which is really kind of reducing friction, reducing regulation, as everyone knows, and then aligning that with kind of carrots and sticks at the local level.
Yes.
So
which have to go together. You can't just have sticks without the carrot, right?
Yeah, precisely, right. And so I think there has been too much resistance and obstacles, and that was a lot of the stick approach. And then I think that the carrots are going to be, figuring out how you can leverage some of those federal dollars for local dollars, and that could be tax abatement dollars.
Yeah. And I think that's what a lot of people don't really understand is, like, it's not that, a lot of the industry would love to be able to provide workforce and affordable housing, but there has to be a funding mechanism for it.
Precisely.
It can't just be a mandate. It needs to be a partnership. And that's why, these programs, when done right, can be very effective.
Yeah. And it's not just the public side, and it's not just the private side. And this is why, finding the tools and the levers and doing it in a real cohesive way is absolutely critical. The federal side, in terms of the federal, work that goes to the state and local, it's their grants.
Yeah.
And effectively, some of them go to the state, and others can be passed through grants that go to the local jurisdictions. And there's typically 4 areas for those grants. That is logistics, infrastructure, education, infrastructure, education, transportation, and Medicaid, and so healthcare.
Yeah.
So when you think of those 4 grant making, conduits, and you think of like who are all the beneficiaries of the housing, is such a central force to all those 4, right? So housing, from my perspective, is infrastructure.
Yeah.
It is so important. It's so essential to all these different sources of grant dollars. So I think making that connection between those federal grant dollars going to the local jurisdictions, the reason that housing should be, supported and incented from that, perspective, is the reason that I do think that there's going to be a path forward for more of those federal dollars, translating to more local movement. So talking about more about workforce housing, we talked about PFCs, HFCs. One of the things we've seen here in Texas, but I think all over the country, but even in places like Texas, which theoretically should be easier and are easier in some cases to build. But a lot of the cities, when we talk to different city council members and mayors and staff, like a lot of them have, I think, misperceptions about what workforce housing is. They may be opposed to a PFC or an HFC because they're thinking, this is going to be the projects. Yeah.
Right. We don't want to, I don't even want to repeat the things that get said, but what they are. People listening know what they are. So does workforce housing, do we have a reputation or an image problem with communities and with some investors? And if so, how do we fix that? And also, a related question, does the name matter? Workforce, middle income, attainable, does that matter at all? I just threw a lot at you, but
these are perennial questions that we've had, for the last at least the last 7 years. I'll address the name, first. And I've gotten this question for years, Jay.
Yeah.
I don't think it matters.
Yeah.
I mean, generally people know what it is. You can have debates about the technical definition, but people understand inherently that for our economies and our country to thrive, you need to ensure that the folks that are teaching our kids, the individuals that are taking care of the civic needs of our cities and our communities, the folks that are the bus drivers, the essential workers, the nurses, that are taking care of our parents and the elderly, these are all essential functions. I almost look at housing, at least in this segment, as a declining natural resource. And we need it to not only function but to thrive.
Yeah.
And so we can call it workforce or attainable and middle income, and there's certain people that are sensitive for different reasons.
Right.
But at the end of the day, we need it, and I think we can all agree to that.
Absolutely.
So the way that I view it is again similar to like impact. We can label it anything we want, but at the end of the day, this is extraordinarily needed housing. And generally, I think there's definitions of coalesced around 60 to 120% of AMI.
Yep.
And mostly, under 80% of AMI. You're seeing agencies and HUD and have been around that 80% of AMI segment. So if you're in that range, then I think you're serving a need. And then in terms of the reputation and image problem with community investors, it did. There was an image and reputation problem before. When I got into the business, we didn't have workforce housing to the point, like, again,
you were ahead of your time. Yeah.
Yeah. So I've seen a lot of different names over time, but the thing that I've seen constant is there's demand and there's interest, and it's been a good investment model that has stood the test of time, even if it has been challenged, but it's still remained resilient. On the reputation and image side now, I'm seeing the opposite effect.
Good.
I mean, you're seeing certainly from an investment community perspective.
Yeah.
There's a lot of, as I stated earlier, being at PRIA.
Even institutional capital, I think they're much more open to it.
Absolutely.
And not just for the impact reasons, right?
No, because of the fundamentals of the asset class. And I think you just enhance returns through the impact. That's how I kind of view it. You got downside protection, but you got upside through some of the other operational aspects of it. So on the political sphere, very popular. And even NIMBYs, I'm not saying all, but even many NIMBYs are attacking the lower end of the spectrum. Middle income housing, NOAA, workforce has really good support from a political sphere perspective, bipartisan support.
But I will say, and sometimes it's like, yeah, we do want it, but it's not here. And then it's okay, well, then where? And those conversations become very frustrating. So I know a lot of developers who want to build this stuff, but they continually run into those kind of arguments because it's not that no one debates the need. They just don't really want it literally in their backyards, right? So there's still some challenges to overcome there.
Yeah. And, it's, sometimes people can't get out of their own way. They say something, and then when it comes to action, it's, there's some rigor mortis that, sets in. But again, I think that's the educational, piece of it. And where's the fear really stemming? It's, again, understanding that, because when you actually peel that back and you really understand what's underlying it, it's like, okay, well, that doesn't exist in this type of community, right? If you really go through that. But no, I think the image is as strong as ever.
Good.
And that's why I think the moment is now to continue to elevate the conversation. And I think over time, again, the more data points, the more proof points, the more stories, the more resident stories in terms of how it's impacting these communities. I think how it impacts the broader economy too. I mean, this is Americana that we're talking about. Yeah. This is America's engine and economic, driving force. So if we're talking now about being, committed and real and serious about American productivity, about even a manufacturing renaissance, about really driving GDP so that we can get whatever, debt to GDP. The only way, the only way to I think overcome those things is through, right? You've seen like austerity in Europe not work, and major setbacks. And so, if we're talking about some of the pressures that our country is facing, the only way to get through it is to grow through it. And you need this as the lifeblood to actually get through it. And housing is the supportive connective tissue and the conduit, in my view, to really drive kind of American ingenuity and productivity in the next frontier.
So you've been on the front ends of the policy side of this through the Multifamily Impact Council, National Multifamily Housing Council. And so I want to ask you one question on the policy side. You told me years ago that too often policymakers tend to regulate instead of legislate workforce and affordable housing. And so as you talk to policymakers, what do you advise them around, what does good policy, what does good legislation look like to support workforce, middle income, and even affordable housing?
Yeah. Well, yeah. And so, if you can't legislate, you regulate. And so that's kind of the reactionary, form. And what's been very important to me and some of the organizations that I work with in NMHC and MIC and really supporting this is being proactive about communicating to legislators and congressional leaders, senatorial leaders, or what are the tools? Because, when I first started in this track and belief system and really I view it as a movement in terms of housing. And by the way, I look at this as we talk about these leadership roles, and I'm so grateful to be in them. They're some of the most influential roles in the multifamily industry that are not paid. And so you have to be very passionate and believe in this. And that's really what it is. How can I advance not only industry forward, but the communities that I feel, grateful to in terms of them providing for my family, and how do I pay it forward? And I view it as my, form of public service. And so one of the things that I'm really proud of through all that work is when we first started this, it was educating lawmakers. That battle is done. It's won.
Good.
So lawmakers understand the need. They understand, what are the driving forces. And not only that, they're getting a lot of pressure from their constituents. And I'm not just saying that it's the voting block of popular, votes, but it's also employers. It's large employers, and now it's gone to those levels, or you're getting PAC and other contributions from employers because they realize for them to be competitive, they need labor. And if they can't have housing to support that labor, there's no way that they're going to be able to reach their capacity and their potential. Now, I was just in DC a few weeks ago. Fascinating conversations with Secretary of HUD, Chairman of House Ways and Means, Jason Smith, Congressman French Hill, Senator Tim Scott. It's the first time I've ever been in DC. Every single one of those meetings, they said it's top one or two priorities.
Wow. So
I found something in DC that I haven't found in a long time. It was a very unique and extraordinary finding. They said it for the first time, and I just learned it when I was out there. It's called agreement, because people are really agreeing and coalescing around, how do we now drive solutions? So the conversation has gone past what is the problem? Okay, let's figure out solutions.
Great.
And so, there's a high focus on supply. I'm a believer that preservation is extraordinarily important. There is a high focus on supply. So that's new creation. Preservation is also supply. It is creation, as we've talked about, Jay, in the past. And so a lot of the conversations have stemmed around what we talked about earlier, tax abatements, and how to connect those federal dollars to the local dollars. And there's a bunch of different incentives and tools and strategies around that. How do we reduce supply? How do we reduce regulation? So there's a lot of move towards that. You're already seeing significant changes occur. What we're monitoring very closely is with all these cuts, are you cutting fat or are you cutting the bones, right? So we'll see how that plays out. But there is clearly a commitment to making sure that there's more efficiency and there's reducing, regulation and certain things that might be impediments. The other two pieces are opportunity zones. I know you've talked about opportunity zones, and the success was much better than anticipated. And I think you're going to see a lot more attention on that. And again, maybe different ways of forming that, going forward. I'm a big believer that opportunity zones shouldn't even be zones. I think it should be place-based as opposed to location-based.
Interesting.
Yeah. I mean, you can get on, some of the fringe areas, luxury product that doesn't even, fit the need for those communities. And so, and that's great, for jobs over a period of time and potentially even tax revenue. But, and there's a piece to that. But I also think, for us to really have meaningful movement, you have to do it in high opportunity zones, right? Economic zones that are near jobs and schools and that sort of thing. So that's why I think opportunity zones should be a little bit more place-based. You might even see some reforms in terms of Section 8 and some the HUD dollars. Now, I don't think there's going to be net new dollars from an appropriations perspective. So DC needs to get creative in terms of how to utilize those dollars in a more effective way. So as we all know, the HCV program, 1 in 4 participants get that funding. So one of the ideas is, again, to leverage the voucher program. Yeah. One of those ideas is to leverage those dollars, again, with other private dollars, almost similar to a tax abatement. Yeah. But it would be a kind of a different form. So again, that would be a little bit more place-based. You go to a community and you provide a voucher value of $50,000, right? And that operator would have to provide $100,000. I'm just using an example in terms of rent, reductions or some other, form to leverage that 50 over 100 so that they can do it over a broader spectrum of residents, as opposed to that HCV going 100% just to one resident, right? Yeah. So that's another kind of, thoughtful way of getting the multiple network effects of different funds.
Like partial scholarships in sports, right?
Right. Yeah, exactly. Right, precisely. And then you do kind of couple that, with again, private sector involvement, very similar to the way that the tax abatement works.
Great. So. Well, Antonio, I appreciate your insight. Thanks for sharing your story, and thanks for being on the front lines of these issues.
This was super fun, Jay. I really appreciate you and taking the time and everything. Oh, wait, I've got a question for you. Uh-oh. We are in. I guess I have 2 questions for you. So we're in Frisco here.
Yep.
In Dallas, and so you might be a little bit biased, but so if multifamily was a sports team, what would it be? And why?
Oh, I'd want to say the Cowboys, but that would be a very bad analogy. Like we would lose
is it Cowboys circa 1990s or is it circa 2025? Because those are
If I said it was the Cowboys of today, then I think every investor would run out of multifamily.
Yeah, exactly. We'd all be shorting it for sure.
No, I think it's if I want to use the Cowboys analogies, I think we're in like the pre-Super Bowl era where we're kind of rebuilding toward a moment, but maybe that's too an extreme. But I don't think we're going to see growth like we saw obviously in 21, 22. But I do think we're entering a period of going from kind of rebuilding era to a more sustainable success given reduced supply and high demand.
Good, that's great. That's good feedback. Yeah, I was going to ask you, are you Team Taylor or you Team Brittany? As well. No, don't go. I'm just kidding. That's the other team.
I don't have a strong affiliate on that one.
We don't want to get some negative comments. And then just in terms of like data points that you come across that are like interesting, what's some of the more interesting or weird or different data points that might be fun that people have?
Yeah, well, I think everyone focuses so much on just the rents and occupancy. We sometimes miss a lot of stuff in between. And so some of the things I find really interesting is looking at some of these more leading indicators of things like, now we can see more information on like leasing traffic. You see like the retention data. And one thing I think is just fascinating, I talked about this recently, is like, just everyone thinks about high retention is just correlated with lack of home purchases. But just for these last 5 years, even pre-high mortgage rates, we're just structurally low turnover right now.
Yeah,
I think that's really interesting. So there's a lot of ancillary data points that and I think the other thing too is I think getting more into things like downtime between leases, understanding some of these kind of sub dynamics that impact the headline numbers. I think are kind of nerdy and interesting, but also important.
Yeah,
I mean, as longer longer unit sits vacant, that's less cash flow. I mean, you could charge whatever rent you want, but if it sits vacant, it doesn't really matter. And so I think structurally, we've seen units move faster in this cycle. Even from slow market to the faster market. I mean, units just don't sit vacant like they did 10 plus years ago. And I think that's a big focus on just turn times, occupancy, cash flow, everything
just
else.
the dynamic of the market that's evolved. And
the professionalization of the industry.
Right, precisely. And it comes back to the consumer and what's occurring in their lives and their job and, some of the behavioral attributes. And then you're seeing that, come up in the data. And to your point, this stuff is nerdy, but it's cool. Yeah. And that's what's great about it. And last thing, because I know we got to run, but I was coming up and I was telling, my team, I'm going up to Priya, and we got, it was a really good session, and Troy Aikman and Anna Smith are gonna, be speaking, and then I'm really excited about spending some time with Jay Parsons. No one cared about Troy Aikman and Emmett Smith in my office.
They must not be Cowboys fans.
They're like, "You're meeting Jay Parsons? Can you bring us?" So we've known each other for a long time. It's amazing in terms of the stories that we've been telling for a long time, and I appreciate your real interest in terms of what we do, and I always love nerding out with you on the data, but it's really amazing in terms of the community that you've also built, Jay. So
thank you. I appreciate it.
It's a pleasure to be here.
Well, thanks for making the trip up.
Thank you.
And that's a wrap on episode number 29 of The Rent Roll. Big thanks to Antonio for joining us in studio for today's podcast. Thank you to our sponsors, to JPI and to Madera Residential. And a thank you to all of you for making us part of your day. We'll see you next week.